The S&P 500 is again hitting new all-time highs, and this is happening right in the middle of September, which is typically the worst month of the year for the market. But September in 2025 is a little bit different. Jerome Powell at the Federal Reserve essentially told us they're going to be cutting rates on September 17th. And in fact, the odds market is now showing it an 89.4% chance we get a 25 basis points cuts and about a 10% chance we get a 50 basis point cut. Now, it is somewhat rare that we see rates get cut when the market is at all-time highs, but this is the reason this is happening. Look at the jobs market. Look at the slowing growth. This is the area of concern for the Fed, but with that being said, what does that mean for the market trading at all-time highs and simultaneously getting rate cuts? Well, here's what's so interesting. 20 for 20. That's the S&P 500's track record over the next year when the Fed cuts rates within 2% of all-time highs. The average return is about 13.9% over the next 12 months. So historically speaking, when we see rate cuts when the market is at all-time highs, the next 12 months for the market is very, very good. Now, with that being said, that's no guarantee that the next 12 months actually looks good. Past returns aren't indicators of future returns. And 2025 has been an incredibly volatile year. But the good news is there's plenty of quality stocks continuing to increase their dividend payout. So regardless of market performance, you can continue to get paid more. So in this video, we'll be looking at 4 different dividend stocks that just announced dividend increases. And let's go ahead and start with one that's in my personal portfolio, and that's going to be Altria, stock ticker MO, and they just announced a 3.9% dividend increase. Now, Altria is a company that's been in my personal portfolio for a while now. If we come down and look at my growth chart, we can see the position's done really well for me. I'm currently up about 70%, and in fact, if we look at my dividend dashboard and blow up my dividend yield on cost, we can see my yield on cost for this position is about 9.27%. That's pretty high. Now, if we look over on Seeking Alpha, we can see this stock is up about 21.5% in the last year, but if we look at the last 5 years, up about 52.7%. But look at this run up from late 2023. It was trading around $40 to $39 per share. So it's been on an incredible run. And at that time, it was yielding around 8 or 9%. Now, if we look at this stock from a dividend perspective, go ahead and jump over to the dividend breakdown sheet and plug in MO. You can see all this data will automatically load in. And real quick, like always, if you'd like to be able to download any of these spreadsheets that you see in my video and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. There's a 7-day free trial. Now with Altria, we can see the starting dividend yield right now is about 6.2%. So still, despite the huge run up in the last year and a half or so, the starting dividend yield is relatively high at 6.2%. And they've been growing that dividend over the past decade at about 6.5%, and the 5-year dividend CAGR at about 3.7%. And this stock is also a dividend king with over 50 consecutive years of dividend increases. So from that perspective, it certainly checks a lot of boxes. But here's the concern a lot of people seem to have about Altria. Look at this free cash flow payout ratio. It's close to 80%. They're using nearly 80% of their free cash flow to pay out dividends. But here's what a lot of people seem to miss. You can learn a lot about a stock or a company simply by looking at their information on their website, reading their press releases, reading their investors' presentation. But one of the things they've stated in prior years is they have a target dividend payout ratio of approximately 80% of their earnings. Now, we have to remember, management teams have to make capital allocation decisions all the time, and in the case of Altria, they've decided the best way to reward their shareholders is to target about an 80% payout ratio. And what's so interesting about this is if we look at the free cash flow payout ratio over time for Altria, it stayed very close to that range. So even though most people think this is a red flag, this is actually directly in line with what management is targeting. And they've done that very well over the last few years and been able to continue to grow the dividend at a healthy rate while the stock has a very high starting dividend yield. Now, here's what's so interesting about this. If they're targeting an 80% payout ratio, that means if earnings grow at about 4%, then the dividend should be growing at about 4%. And to start, if we look at their recent earnings presentation, they actually increased their 2025 guidance. They increased earnings expectations. So what that means is, if we actually look at earnings growth projections for this company, let's start with looking at it on Seeking Alpha. We can see earnings estimates range over the next 3-ish years, typically around 4% on average. So with that being said, if they're going to keep that 80% payout ratio, we should be expecting around 4% dividend growth, combined with a dividend yield of around 6.2% at its current prices. We can also perform a pretty precise dividend discount model, giving us an accurate valuation based on that information. But first, I'd like to say thank you to Moo for sponsoring this video. Moomoo is your one-stop global trading platform with over 37,000 listed companies' financial data and over 26 million global users. And while Moomoo does have $0 commissions on stocks, ETF, and options trades, it's much more than just a brokerage. With Moomoo, you can read market analysis, you can see things like the heat map, and you can utilize stock screeners either with your desktop or with the mobile app. And one of my personal favorite features is the institutional tracker. For example, we can look at Warren Buffett's Berkshire Hathaway and look at what he's holding in his personal portfolio as well as seeing his latest buys and sells. On top of that, you should definitely take advantage of their earnings calendar, where you can see a list of the most important stocks getting ready to announce earnings in the upcoming days and weeks. And for a limited time, you can actually get an 8.1% APY for the first 3 months on your uninvested cash. And along with that, you have the potential to get $1,000 in Nvidia stock if you deposit $50,000. So check out Moomoo at the link in the description to get up to $1,000 in Nvidia shares with qualified deposits. If we jump over to the stock valuation sheet, let's look at Altria. Let's jump over to the dividend discount model. Now again, the idea behind a dividend discount model is we should be able to value a stock based on how much they're paying out in dividends and how much that dividend is increasing over time. So let's be somewhat conservative with our projections. Maybe they achieve about 2.5% dividend growth moving forward. All of a sudden, the fair value would be about $64.34, pretty much in line with the current share price. But if they're able to achieve around 3.5% dividend growth, which at least in the short term certainly looks doable, all of a sudden that fair value jumps up to $76.78. So even with the recent run-up, Altria is still somewhat interesting at its current prices. Next up, we have what was once a pretty popular dividend stock in Verizon, and they just had a dividend increase of 1.8%. Now, this is what I call the dreaded below inflation rate dividend hike. What does that mean? Well, anytime a stock increases its dividend, but the dividend hike is below the rate of inflation, then that company is technically paying out less in dividends than the previous year. So while it looks great on paper that they're continuing their dividend streak, in reality, inflation is decreasing the purchasing power of those dividends. So definitely something to keep in mind. Now, if we look at Verizon in the last year, they're up about 1.38%, and year-to-date so far, currently up about 8.33%. So they're keeping up with the market when you include the dividends, at least year to date. Now, one thing I do want to make note of, when we talk about stocks that are higher yielders, but growing their dividend at a slower rate, there are other ways to mitigate inflation risk, such as you could potentially reinvest a portion of those dividends to offset the purchasing power loss. This is one of the strategies I was talking about over on dividendology.com just the other day. There's a link in the description. But let's go ahead and look at them from a dividend perspective. And we can see the starting dividend yield is pretty high, actually, at about 6.26%. They grow those dividends over time, but we can see it's certainly the trend that they haven't been increasing the dividends at a very high rate over the past 5 or 10 years, around 2% for both of them, which in a lot of scenarios is not good news. Now, the good news actually is we can see the free cash flow payout ratio only about 59.45%, and for the most part, with the exception of 2020, it's stayed around that range at least since around 2018. Now, if we go ahead and look at this stock from a valuation perspective, again, let's look at it from a dividend discount model perspective. We'll go ahead and zoom in, and let's assume they continue to get that trend of around 2% dividend growth moving forward. That's pretty close to what that most recent dividend hike was. Assuming that number, we can see the fair value for this stock would be about $39.49, which is actually about 8 to 9% lower than that current share price. Next up, we have East Group Properties with a really nice dividend hike coming in at 10.7%, so close to 11%. And if we look at East Group Properties in the last year, yes, they're down about 10.3%, but year-to-date up about 3.51%. Now, if we just go directly over to the dividend breakdown sheet, I've already plugged in the ticker, we can see they're yielding about 3.44% with a pretty impressive history of dividend growth. Now, this is where it becomes really important to understand what type of entity we're actually looking at. What we're looking at is a real estate investment trust. So what does that mean in regards to dividends and more specifically dividend sustainability? Well, it means we don't look at typical earnings payout ratios or even free cash flow payout ratios. We need to look at the adjusted funds from operations payout ratio. That will tell us the true health of their actual dividend payouts. Now, the problem with a lot of these alternative asset classes like REITs or BDCs or covered call ETFs is it's really hard to analyze the dividend metrics because most softwares don't carry information. Now, I am a huge fan of Seeking Alpha, and they actually do give you one AFFO payout ratio metric you can see right here on a forward or trailing 12 months basis, but I prefer to see the trends over time. which is the exact reason that over on Dividendology.com, I've been building out a database. Now, there's tons of free resources on this database, but to the Dividendology.com members, I also have the covered call ETF database, the BDC database, the REIT database, Super Investor database. There's certainly plenty of important metrics and tabs in this database, but we're just going to look at the AFFO payout ratio in regards to EGP, and we can see it's listed right here. Now, it looks like there's a lot going on, but pay close attention, this is important. So what we're looking at again here is the adjusted funds from operations payout ratio over time. And what we can see is, especially in the last few years, this has increased significantly. It was sitting at about 59%, let's see, from 2017 to 2019, and in the most recent years, it's climbed all the way up to about 80, 82, 83%. So yes, the dividend has grown at a high rate, but this is one of the instances where it hasn't all been what I would call sustainable dividend growth. Yes, a stock can grow its dividend at a high rate in the short term, but if the payout ratio at the same time is also climbing higher, then that's not sustainable dividend growth over the long term. Either the stock's free cash flow has to be growing at a high rate as well, or in the case of REITs, the adjusted funds from operations has to be growing at a high rate as well. Now, with that being said, this is a REIT that typically grows funds from operations or adjusted funds from operations quite a bit faster than a lot of other REITs, and they trade at a bit of a premium because of that. We can see the price to FFO ratio right here on a forward-looking basis, according to Seeking Alpha, is about 18.77. Now, with all this being said, it's really important to note that the REIT market in general has lagged the S&P 500 and equities in general by a significant amount, especially in the last 3 or 4 years. Now, historically, REITs have actually outperformed the market over most decades. The 90s, 13.5%, 2000s, 14.2%, 2010s, 13.2%. But in 2020 to 2024, it only returned about 5.5%. Meanwhile, its average return over the other decades was about 12.4%. And so what's happened is we can now see a very wide spread in the earnings multiples when it comes to REITs versus other US listed equities. And historically speaking, when we've seen really wide spreads between REITs and other US equities, the returns have been very good for REITs, and typically over the next 1 to 2, 3 years, according to the historical data, REITs outperform. And then finally, we have another large dividend hike from CBOE, and that dividend hike is going to be around 14%, in fact 14.3% to be specific. And if we look at the last year, they're currently up about 10.9%, despite seeing a little bit of a sell-off in the last month, currently down around 7%, if we look at their dividend profile. What we can see is this is the lowest yielder we're looking at to date, about 1.23%, but they definitely make up for that with the dividend growth that we've been seeing over the last few years. The 10-year dividend CAGR, 12.6%, in the 5-year, a little bit above 13%, and then of course that most recent one, just phenomenal, at 14.3%. That is really fast dividend growth, and it'll certainly increase that dividend snowball speed. You can see back in 2014, they were only paying out about 78 cents per share, and now they're about $2.88 per share. And of course, most importantly, this has been backed by growing free cash flow. So like I said earlier, dividend growth can actually be unsustainable if the free cash flow payout ratio is increasing, but that hasn't been the case at all in the case of CBOE. In fact, the free cash flow payout ratio has actually declined in the last few years. It's only sitting at about 24%. So there's certainly room for them to continue to grow the dividend at a high rate moving forward. Now, let's use a sensitivity analysis to actually value this stock. If we come up here and use CBOE, basically what we're doing is we're seeing what our expected future returns could be based on the projected EPS growth and our projected PE ratio. Now, one of the cool features of ticker data is you can automatically import into your spreadsheet the average estimated EPS estimate from analysts. So these numbers we're seeing right here, these are the average EPS estimates from analysts. And over the next few years, through 2029, the projected EPS CAGR is about 8.59%. So with that number, let's just go ahead and assume they achieve the average EPS estimate. We'll go with 8.59%. And now, of course, I don't want to be over optimistic with projections. So even though the average PE ratio is about 32.64 in the last few years, maybe it's raised a little bit higher because of outliers in 2016 and 2022. Either way, I still want to be more conservative with my projections. So let's assume that the multiple actually contracts even more. It goes further down. We'll assume a 26 PE multiple, and you can see we're actually looking at pretty solid returns from 2026 through 2030. Each year, you're looking at a compounded annual return of above 8%, And keep in mind, that also doesn't include the dividend that you're going to be getting that's going to be growing at a double-digit rate. So there you go. Those are 4 dividend stocks that just recently announced dividend increases. Again, go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to download any of these spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.